Hey everybody, welcome back to Methods of Modern Finance. I am really excited for today's episode and to be able to introduce you to a dear friend of mine and another person in the financial world. Wow. Did not know that was going to happen. Anyway, so we are excited to be able to talk to you about a very, very important topic. I wanted to really quickly do a disclaimer. We are very grateful for our funding, in part by the U.S. Small Business Administration, that helps fund our Small Business Development Center here in Blanding, as well as the USU, the Work in a Cooperative Agreement, that are able to help us deliver classes like this. Today's topic is very near and dear to my heart, coming from the financial world that I have before I came here. I got to see a lot that's related to this topic because it's one that I worked with very closely. What we're going to talk about today is buy-sell agreements and how that they work with succession plans and how they impact your business. And I'm bringing Ray Rosales in to talk specifically about those because that's who I work with as far as my own personal, but as well as I want to talk to you about how that has impacted business. So in the last year, we've had COVID-19 hit the U.S., it's hit all over the world, and it's impacted businesses very, very deeply. One of the ways that I don't think has been addressed or has been talked about much is how that has impacted the partnerships and addressed how the passing of either one of the business partners or one of the business partners becoming so ill that they're not able to become or go back to work, and not having that buy-sell agreement set up and not having things in place to be able to cover your business has actually forced some businesses either to sell because they don't have that key partner, or the business has been transferred to the business owner who passed away's estate, and that estate is either now your new business partner who either knows nothing about the business or might want to take the business in a different direction as what it was before. So there's some different aspects that play here. The other thing is that it plays into the fact that, for example, one of the clients that I worked with before, they had a business set up where there were two LLCs. We had a total of 4 people in the business partner with 2 LLCs operating a couple of different businesses. They had written a buy-sell agreement. They had written it in place, but they didn't properly fund that. There was a death of one of those business partners, and what had happened is they had gained a new business partner, as in the wife of the person that had passed away, and she did not want that business, and she forced the sale of the business because the business owners did not have enough money to buy her out as a business partner, even though the buy-sell agreement, that's what it said, is that they had to sell, they had to buy that business owner out. And so it creates a tricky situation when we don't have those properly set up, when we don't have those properly funded, but it also creates an even trickier situation when we don't have that plan set up if something were to happen and you're not prepared for business. We are just, it's just one of those situations that when you're watching out for business and you want to move forward in the right direction, you need to sit down and take the time to write a proper buy-sell agreement, and then also make sure that it's funded and you know how that's going to work, and then all of the parties that are affected also know how that's going to work. So I'm really, really excited to bring Ray on. I'm going to have him explain to you the details behind buy-sell agreements and how they can affect your business and the different details. So I'm going to actually turn that over to Ray. If you have any questions as we go through this, feel free to let your director know of your center, or you can send them through the chat. And then as we get time or the proper appointment, I will ask that of Ray so that we can get all your questions answered. So take it away, Ray.
Okay. Thank you, Megan, for that wonderful introduction. And I'm glad to be here talking to you guys today about these, what Megan has said is buy-sell agreements and how it could help a business owner in case of, the worst case scenario. So I'm going to go ahead and share my screen really quick. Megan, are you seeing that?
I am.
Okay. So, guys, a little real quick, I'll just take a minute to introduce my. I am a independent broker in financial services. I own my own business out here in California. I know we have people mostly from Utah, I believe, but I'm out in California. I'm licensed in California. I'm also licensed in the state of Utah. So, like Megan said, I'm going to talk to you guys about particularly, specifically, buy-sell agreements. Now, my own little disclaimer is I'm going to go over kind of a high level, because these things can be very confusing, very legalese written. There are a lot of agreements in here, and you have to have attorneys present. So I want to give you guys a high level, just so you understand the structure of it and the basics of it. So with that said, again, thank you. So what I want to talk to you guys today is how life insurance can work for business owners to have a successful succession planning strategy. So what you want to do is most people, they're especially the way, if you're set up a certain way, you want to run your business, but you also want to protect your assets. So the main priority for business owners and managers is the daily operation of their businesses. They got to worry about the sales, production, cost control, quality control, on-time delivery, the customer services, employee relations, everything. If you're like an owner slash manager slash proprietor, you have to do everything from not only run the business, own the business, but you may have to order the supplies. You may have to make sure, you may be doing the payroll. You may be doing some of the HR. So most of your daily activity needs to be running your business, but you also want to protect your business. So life insurance for businesses provide an invaluable benefit. It allows business owners and managers to focus on the primary daily functions of managing their business, but it's offering protection against, unexpected contingencies. For example, business insurance can protect against property and casualty losses, litigation, business interruption from natural causes, labor issues, disability, death, etc. One of the good things is and I'm going to talk about this later, is it doesn't have to be one of these catastrophic events. It could be something as simple as retiring. What if you're going to retire? Who is going to run your business after you if it's not a family-run business? Make sense? So, a couple stats. 60% of small business do not have a succession plan in place. 50% of owners with no plan do not think that plan is necessary. So, again, especially in family-run businesses, everyone assumes that, oh, my spouse will take it, my wife will take it, my husband will take it, my kids will take it, but that's not always the case. And I've seen this a couple times personally. So many business owners neglect the succession planning because, one, they don't have the time. Okay. It does take time to set these things up. And sometimes it's finance because they don't understand the way it's structured. There's something called head in the sand theory. Your business is running, humming along, everything's working fine. You're not worried about what's going to happen in 10 years. You may be a young business owner, and it's no different than having life insurance. Life insurance, most young people don't believe they need life insurance because number one, they're young. But what, something that is inevitable, everybody gets old. Everybody's health declines, so they tend to not put it in place, or they tend to put it in place when it's too late. Just like life insurance, business succession planning should be done in the early days, when it's probably going to be cheaper. There's no successor in sight, so again, let me go back to that example of, what if you're a mechanic, you own an auto body shop. What if you are the owner? What if you are the mechanic and you're the manager? And what if your family, your wife or your spouse has a full-time job? What if there is nobody to take over after you? Not only is your business and your family dependent on that business, on your garage, your auto body shop, all of your employees are dependent on that business also. So this is also, you have to think of it in the bigger picture, where if you have the proper succession planning, not only is your family going to be protected in your estate and your assets, you're protecting the livelihood of all your employees, you know. And number four, the last one, they think it's not necessary. I don't understand why they would not think it's necessary. Again, if you understood what could happen and all the downsides that can happen if succession planning isn't set up right, you would understand why these things need to be done. So here's the thing. Business can continue even after a catastrophic event. So what business life insurance ensures is a successful continuation of the business. It protects the invested time and assets. You know, planning for the continuation of your business is always associated with how the business entity has been structured. So I'm going to go into a little bit of the different type of businesses and how they're structured. You know, is it a sole proprietorship? Is it a partnership? Is it a corporation? Or is it LLC, limited liability company? You know, the answer to this question dictates how the company manages risk in terms of human capital, or what and will may happen to the business, to the investors, to the employees, and to the families of the employees in the event of a death, or what we would call a triggering event. You know, business owners and managers that understand these, they plan for these things. You know, there's a sayings that they say, people don't plan to fail, they just fail to plan. You know, in business, in life, it's always, if you're thinking about things because something happened, then it's usually too late. These are the things that you need to, at least, if you're not going to, you're not going to move forward with anything, at least be educated and understand what is out there, because there is a lot out there in terms of business. Okay. So guys, time and money. Failing the plan could lead to, remember, threat to retirement, change in insurability, because again, everybody gets older, everybody's health declines. You have hardship to surviving spouse, potential fire sale of a business, kind of like what Megan's little example was. The spouse, the estate didn't want the business. They forced the sale. It was a fire sale. The other three owners, I'm sure they had different plans for that business, but because one of the owners, something occurred, they were forced out of that business. You know, it protects against unfair treatment of family, and the business may not survive long. So it's always kind of balancing. It's a balancing game of time versus money, or money versus time. You know, that's where these type of plannings, and somebody like a Megan or somebody like me in the financial services who work with top tier companies, can get these things set up and help people understand how these works. So 40% of family business owners expect to retire within 10 years. You know, again, if you're going to retire, what's going to happen to your business? Is there a succession plan for you to retire? A lot of business owners, a lot of self-employed, a lot of people, they end up working well into the retirement ages because, you know, number two things, they didn't set up enough for their retirement. And number two, there's no way for their business to continue without them. Makes sense? And so 67% of family-owned businesses do not survive to the second generation. You know, these are from Family Business Alliance resources. You know, these are just stats. A lot of businesses, again, if the family or the spouse or the estate doesn't understand that business, they're not actively involved in that business on a daily basis, it's very difficult for that business to succeed. Now, if there's partners, the partners may be able to run that business, but they have to take care of the ex-partner's estate. Makes sense? So that's another reason why these things are so important. So how you can utilize insurance. I'm sorry?
Ray, I'm being asked, what's the difference between key person insurance and business life insurance? Because they had just gotten a policy for key person insurance, and that should cover them.
Key person is sort of like executive bonus. Key person is, let's say me and you have a business, Megan, and we are both key person. We are both key players in that business. The key person insurance is basically, we're buying insurance on each other in case something were to happen to one of us. One of us say, we're no longer interested in the business. You can buy me out so your business can continue to thrive. Because I may be the workhorse and you may be the brains. One of us cannot continue the business without the other, So the key person will cover costs to replace me. Does that make sense?
The other thing on key person insurance is it doesn't have to be an owner of
Correct.
the business. It can be like a major player as an employee
Yes.
that you can do key person insurance on. So that's
Yeah,
another
there's
big
a
difference.
there's a big difference between key, and buy sell. Buy sell is more of a corporation protecting itself, where a key person could be, hey, this is my general manager. I need to protect in case he leaves me.
Yep.
Okay. Hopefully that helps. So how we can utilize insurance as a reasonable option. So the use of insurance to helps create an exit strategy for a business owner upon the occurrence of a triggering event. Now that event could be death, disability, and retirement. Those are the three main ones, but there's other reasons too, because somebody could leave that industry, or there's things, but these are the three major triggering events. It's to pass a business from a business owner to a family member that is active in the business upon the business owner's death, retirement, or disability. Again, if you do not have a succession plan, can that, or you do have a succession plan and it's in the family, this will help protect your family's estate and assets. So technically, basically, how insurance can help a business is, instead of a business closing, an insurance business plan can help keep that business open. So what I want to do now is I'm going to go into the four major types of key buy sell insurance, and how they work. Kind of that. Remember, I'm going to go on this overbroad general explanation, just just to keep it basic, because these things can be very, very tricky, and a lot of legalese. So a funded buy-sell arrangement can be cash value life insurance. The cash value of life insurance policy may be used for part of a lifetime buyout. The owner of the policy may use any cash value to pay for the buyout, or use it as a down payment toward an installment buyout. So there's different ways we can do this. So what I want to do today is I want to typically go over the four types that are out there. So there's something called the stock or entity redemption. There's a cross purchase, something we call a wait and see, and then a one way. So basically, again, these are all going to save you money and your corporation in the long run. So let's go into the stock or the entity redemption one. So a stock redemption agreement is between the business and the business owner or owners. The business is obligated to buy the departing owner's share of the business for an agreed upon price once a triggering event occurs. Remember, the triggering event is death, disability, retirement. Those are the main things. If a cash value life insurance policy is used and paid for by the business, then the business is the beneficiary of the policy. At the time of the business owner's departure from the business, the beneficiary can use the cash value to initiate the buyout. So the way the stock into redemption works is, so you have a business owner. That business owner will have an agreement with the business. So this agreement is usually done by an attorney, or somebody for the business or the owner. But again, it's a legal contract, it's legal binding, and it's a 100% legal contract. So business owner and business, they have an agreement. So what will happen is the business funds an insurance policy on the owner. Okay, remember, the business funds the policy on the owner. If this is set up correctly, the premiums that is being funded by the business, again, if it's set correctly, you can actually use those as a tax write-off, because it's a business expense. So it can actually help your business bottom line, save some money, and help you with some write-offs. So the business funds the policy. In the event of in any catastrophic event, any triggering event, the insurance will pay out to the business because they are the beneficiary. So
Another big triggering event that needs to be included these days is divorce.
Yes,
because you don't want your business to go into a divorce court and be split up in a divorce court and run into that same situation. So
exactly. That's a good point. Thank you, Megan. So in an event, the insurance will pay out to the business. So then what the business will do is they can use those funds to buy out the departed owner's estate, meaning the spouse, the family, so that's basically a stock redemption. Now, the owner, the estate also has a choice to sell or not sell. So that this is where the agreement comes in very handy, because again, without that agreement, if it's not specified, these things can go either way, because the business may want to buy out the owner, but the owner will say, I don't want to sell, or the estate will say, I don't want to sell. That's why the agreement is very, very vital in this whole process. So that's a pretty simple explanation of a stock redemption. Pretty simple. So now there's something called a cross purchase. So a cross purchase buy, this is the sell agreement is between the business owner and the remaining business owner or owner. So again, it can be two owners, it can be multiple owners, it could be, again, later on, it depends how you are set up. But again, these are just high level how it works, so you have an idea. So in a cross purchase, if the participants choose to fund the agreement with life insurance, the business purchases the agreement, the insurance on all parties. During a triggering event, the remaining business owners utilize the cash value from the policy to initiate the buyout depending on the owner's estate. So again, it's not much different, but there's just a couple changes. So the owner has an agreement with the co-owners because there's multiple ownership. Remember, the agreement has to be very specific, and it should, if you want it done right properly, be done by an attorney. So the co-owners are they fund the policy. Now they have to fund policies on all owners. So the co-owners using the business funds, again, if it's set up right, everybody in that group has to have a policy. Makes sense? It's not just the owner now, it's the owner and co-owners all have to have a policy. So in the event of any of their departure from the business, the insurance will pay out in any event. So what will happen is then the co-owners, the remaining co-owners, can buy out the departed owner's estate. So remember, again, the agreement is one of the major parts of these purchases, not just the life insurance and how it's funded, but the agreement is going to be very key to how these things work. So then there's that buyout, so that's your cross purchase. Not too complicated, but again, it has to be very specified. So there's the third type is called the wait and see. So the wait and see agreement gives the business the first option to buy the departed owner's part of the business. Okay, there's options in this one. The co-owners have a second option. If either of these occur, the business is required to buy out the departed owner's interest in the business. If the business buys the shares, the remaining co-owners may contribute the proceeds of the policy to the business. Why this isn't great is they can increase the remaining owner's stock in the business. Note, this is typically a little bit more complex agreement. So this takes a little bit more because there's a buyout, there's a loan, and the remaining co-owners can actually put the money back into their business, and it's a beneficiary. It's a death benefit. So how this works is you have your owner. The owner has an agreement with not only the business, but the co-owner. So there has to be two agreements. Okay. The co-owners here are the owners. They have to fund the policy on all owners, on all of the bodies. So the owners have to buy the insurance for everybody. But the agreement has to be between both the owners and the business. So in any event, the insurance pays out. So now here's where it gets a little confusing. The business has the first buyout option. The business, even though the co-owners own the policy and are the beneficiaries, the business has the first option to buy out the estate. Okay. Now, if that doesn't happen, the co-owners have the second option to buy out the estate. If neither of these happen, again, the estate has to agree to take the buyout. If either one of these happen and they buy out the estate, any remaining money, the co-owners can contribute that to the business, therefore increasing the business with a death benefit. Imagine you being able to have an influx of cash after you pay out your co-owner estate, set their family up, set their estate up, and you have still an influx of cash to put back into your business. Because this way, the owner might have been a major part of that business success. Without that, they're going to need time, resources to put back into the business to replace that owner, that departed owner. Does that make sense? That way, the life insurance payout, the cash value, could be used as bridge money to say, hey, we lost Jeff, we lost, owner A. Owner A knew how to run all these machines, or how to fix all of these, problems. We need time to get somebody else to replace that. That's why that contribution's there. So this is a very great setup, not only to take care of the co-owner's estate, but to take care of the loss of that co-owner to the business. So that's a pretty good option, is wait and see. Now, then there's also something called a one-way. The one-way is similar to a cross-purchase agreement, except it only goes in one direction. The major difference is a key executive is planning to buy the sole business owner's part of the business. The key executive purchases the life insurance policy on the business owner's life, therefore becoming the owner and the beneficiary of the policy. When a triggering event occurs, the key executive uses the cash value to initiate the buyout. So this would be sort of that key person. It falls into that because the key person is not the entity. It's like a high level person of the business. So the way this would work is the key executive is going to purchase insurance for the owner. Pretty basic stuff. In the event of a catastrophic or a triggering event, the insurance will pay out in that event to the key executive. So it goes in one way. It's kind of a circle, but it's still going one way. Then the key executive is going to take a portion of that money, or all of the money based on the agreement, to buy the departed owner's estate. So that's why they call it one way. It's basically, I'm buying it, I'm the beneficiary, boom, you have them, I'm buying out your estate. Now, a couple things, again, it's the way these things are structured, the way it's all put together. You can actually, in case of not a death or a disability, there could be a retirement. The owner always has an option. Again, if it's structured correctly, the owner has an option to buy out that insurance policy to make it a personal. So those are other options. I didn't want to get into the whole thing, but I just want to, make sure you guys understand that the owner always has an option to buy out the policy and take it with them. Basically, makes sense. So instead of like leaving the company, retiring, and your co-owners being the beneficiary, you can always buy them out and keep that policy for yourself, because it's being funded all these years by the business. Makes sense? So there are 4 common business structures, and this could vary, and there's many more out there, but these are the 4 common.
Hey,
So
Ray, I've got several questions before we move on that we should probably address. So the first is, in what stage of business should we be planning this?
You know what? That's a $1 million question. So again, if it's a brand new business and you're not, and you're struggling, again, it's really going to be up to you and your partners or your business, because there's so many factors here. Again, if you're buying life insurance is based on a couple major things: age and health. So if you're young, life insurance is always cheaper. So as far as a business expense, if you want to be cheaper, because here's the thing is, if you're older, if you're diabetic, if you have these other, ongoing chronic conditions, sometimes you're not not insurable, or you're very expensive to insure. So you have to weigh in a lot of different aspects. It's who are you insuring and what are you insuring, is going to help drive this. I would always say personally, um, because again, businesses nowadays, especially after COVID, after a pandemic, a lot of businesses had to change. And if you can't change, or you can't, and you couldn't restructure in the new kind of norm, your business might have, your business might struggle. So, in hindsight, there's a lot of businesses that probably should have had something in place, because a triggering event could be bankruptcy. Make sense? So, hope, so again, I don't want to be the guy that says, get it, within your first year of business. But again, it's really going to be based on the type of business you have, the type of partnership you have, and kind of your long-term, goal, and a little bit about what your age is at the time you start that business. Does that help?
The longer you wait to put a plan like this in place, the more risk you put yourself, your family, and your business in. Because if it's not in place and something happens, you now put your family at risk. It's the same
Correct.
reason why we talk about key person insurance and making sure that that's in place. If something were to happen to you, what would happen to your family, because you're the major breadwinner for your family, maybe.
Yep.
That the same concept. The longer
Yeah.
you wait to put something in place, the more risk you put on your family. As when I'm working with my businesses here at the center, we start talking about succession plans and buy-sell agreements and the legal aspects of business in the beginning, in the startup phases. And we have a plan to put that into place almost as soon as we can. The financial might not be there for the life insurance, but the agreements and things like that need to be thought about, and who's going to buy out who, and how's that going to happen in the event of a divorce, in the event of the loss of life, in the event of a major catastrophe like COVID. Anything like that needs to be thought out of in the startup phase, so that if you go through that in the middle of a growth phase and you don't have time to sit down as a partnership or as a board to go through that, you have a plan in place, or at least a structure of a plan to start following, so you're not in the middle of a mess trying to wonder what I'm going to do.
Exactly.
So the
Yeah.
next question is, as a startup, I'm worried about money. The money I have to get going, is this the right time to do this? So I think we've kind of already answered that, but do you have anything else to add on that?
Yeah, again, it's always finances at the end of the day is always going to be the issue, because again, it's no different than personal life insurance. People always think I'll get it when later on, but by then again, insurability. The earlier you start, the younger you are, the more insurable you are. Again, it's just like life insurance. If you wait till later, 10 years later or a year later, you're a year older, you have a year more of health issues. So again, I get in the beginning stages, there's finance, but that's where the big part is, if you structure these correctly, the corporation or the business is the one owning the life insurance and funding the life insurance, that becomes a tax write-off. It can, I'm not saying it will, but if it's written correctly, it could be a business expense, which becomes a business write-off. So that sort of can offset the finances, hopefully.
Another thought process could be, right now might not be the right time to get the policy because the finances aren't there, but you can start thinking about how to reduce the cost of your policy. Maybe there's some health concerns, getting in the best shape of your life type of a thing, so you can get your policy and have the lowest premium. So that is another option to be thinking about if you're a startup and you're not ready financially to get a policy, because you don't want to get a policy and then have it go unfunded. So.
Correct. Yeah. And then basically, if it's unfunded and if something happened, it's technically a lapsed policy.
Yeah.
So you can have all the agreements in place, but if the financial backing isn't there, if it's not funded correctly, or it lapsed, and then really the agreements are just agreements.
Mm-hmm. Exactly. The next question is, do I need to do this after my company is worth a certain amount of money?
That's again, that's one that's a $1 million or loaded question, because you have to remember, if you have multiple corporate or owners, and your business blows up and it's worth, and you get, and you get evaluated and your business is worth a lot, then the insurance becomes much more, because you have to have a higher payout. So I mean, again, that's kind of a personal, it's like a preference. Hey, do I want to insure me when I'm not successful, just in case, or do I want to insure me when I'm semi-successful or when I'm too successful? And doesn't matter how much again, it's going to be dependent on every different structure of business, and where that business is at, and financially also. So, that one really, I would have to talk to you individually, and basically weigh all the options of buying it now versus waiting.
That's the hard part of it. You can't really say this is the exact roadmap for
It
every
doesn't
business.
exist.
Every business is going to be different.
Yeah, it doesn't exist, or I would probably have been sued a million times already.
Right. So the next one is, if I get a divorce, which is better, a key person or this option?
Um, it would, again, that's going to really depend on how you're structured and what your business is, and just looking over, over high level overview. Um, I think either would work. A key person would probably be better, but again, remember, the key to any of this is the agreement. The agreement has to be so airtight. And again, you can never plan for every contingency, but you have to plan for as much as possible. So a lot of the way these things are done and executed is all in that agreement. So for a divorce, I would probably lean more to a buy sell.
I'm getting a lot of flack for talking about divorce and business and divorce. And the reality is when you go into business, divorce rates seem to increase. And if anything, we've seen that very much so, especially through COVID. You've seen a lot of amazing business owners that have been very high profile go through divorce in the last year. The reality is going into business with your spouse, with your partner, or even if you're not in business together, but going into business puts a lot of stress on your relationship. And that's why understanding that and how that's going to affect your business and your family as you go into business is going to be huge. And I highly encourage families and partners to go through relationship building classes, and even things to keep their relationship strong, because it is such a hardship. Because if you're independently out building business, it takes you away from family. It also it's just extremely stressful. So that is why that increases so much more when you go into business. So that's why I added that in there, because it's something that we're seeing a huge increase on. So sorry, but it's a sad reality. I feel bad. And then the last quick question is, what if a partner doesn't want to do this? Can I still get protection?
Well, again, the agreement has to be among the partners. So if one partner is not willing to do the agreement, that's where you can go into other avenues, like a key person, or an executive bonus or something like that, where, if the partner doesn't want to do an agreement, you as a co-owner can still buy your own insurance with the business, and again, that's a whole different topic, different class, but there are ways that could be structured if all the partners are on the same page. There are things like executive bonus or key person where those could fit in that model, because there's no agreement. Hopefully that helps a little bit.
The other thing is the partners need to understand this is a protection for all of the partners. And it's hard for them to understand. It's like a prenuptial agreement. Everybody kind of is, why am I signing a prenuptial agreement if it's planning for failure? The truth is when you put a prenuptial agreement together, right, you're doing it to protect the person because you love them. When you do a buy-sell agreement, when you're putting these legal things in place, you're doing it to protect all business owners and to protect the business that you are going to create, put blood, sweat, and tears into. So it's a protection for everybody involved. And the true understanding for that is very, very important as you go into those agreements and go in and start working with an attorney to create these agreements.
You're absolutely right, Megan. Again, it's really just the success of a business. And I really, if you sat down with a partner that wasn't willing to do this because one, it could be finance, two, it could be, they may think, oh, what are you trying to, there could be a million reasons. There's so many social aspects out there. But when you sat down, just like you said, it's really for the protection and the well-being of the business. It's protecting the business, no different than you protecting your own assets. So it's again, because it's more than just you and your partner. If you have employees, you have to think about all of their families who are dependent on that business. And if you have things like this in place, that could be kind of most people that work for a living, what they're looking for today is, benefits, health insurance, and 401k, retirement. But if you know that if you're going into a personal family business, you're going to be working for a family business or a partnership. If you know that there's a succession plan, that might help with retention, because businesses, people don't want to go work somewhere and be out of a job in 3 years or 4 years. They want something that they can hang their hat on, their hat on. So, there's a lot of benefits for these things. I don't see any disadvantages. I mean, except for maybe the paperwork.
Yeah, the cost of the paperwork, I think, is the one thing that deters people, because you do have to get an attorney to draw these up. And I encourage you to get a business attorney to make sure that it's done properly. And if it's one of those things, but I think that people avoid doing things because of that cost. When you're first starting up your business, you're trying to get all your funds and you're just trying to get going, right? Every last drop goes towards the business. And I totally get that. I'm a business owner. I'm an entrepreneur. I've owned several businesses. At the same time, you are protecting your family. This goes back to that risk, right, that I talked about. The longer you go, the higher risk you put on your family and your business. The same concept. The longer you go without having the legal side, the legal agreements, the paperwork, the buy-sell agreement, arbitration agreement, termination agreement, all of that stuff, partnership agreements, all that stuff in place, the more risk you subject yourself and your family to, along with your business. And that is, for me, is scary, because I watched the disaster of not having those in place and seeing the problems. So yeah.
Exactly. And there's one last thing too, is, when businesses succeed, not 100% of the time you and your partner are on the same page of where you want to move that business. And a lot of times when businesses dissolve, it's because of disagreements. That doesn't have to be a death or a retirement or a disability. Sometimes businesses just cannot succeed because they can't get on the same page.
Yep.
And this will cover that, and was there any other questions, Megan?
Nope, that's it.
So I want to go over a couple of the common business structures, and then kind of like how this can help each one of those. So, there's number one, the sole proprietorship, partnership, corporation, and then the limited liability company. So these are your four basic types of business. So how can insurance help with business? We're going to discuss the two common structures. And right now, today, with COVID and people starting their own businesses, a lot of people are sole proprietorships or partnerships. So I'm just going to give you a few examples of how what we talked about just now, high level, can help each other. So on a sole proprietorship, what happens if the sole proprietor passes away? So what happens if there's no agreement? The business would cease until a probate court appoints an administrator. So imagine if you're a sole proprietor and you pass away and there's no agreement or plan in place, your business, even if your family can run it, your business is basically going to cease until that probate court appoints the administrator. Makes sense? Now, again, it's most likely going to be that family member who's involved in the business, but probate court still is a long process and an expensive process. What if the proprietor left a will? A lot of people think, oh, I have a will. These things are still good. My business is good. But the executive of the will administers to the business according to the will. Now, what if, again, you owned a garage, you were a part owner of a mechanics, an auto body shop. You're the manager, you're the accountant, you're one of the mechanics, and your spouse or whoever the executor of your will, what if they don't understand that business? What if they're not active in the business? Now they become the executor of your will and your business. What's going to happen to your partners? Remember, a lot of times not a lot of times, but there have been times where businesses have been dissolved because the spouse forces the sale, kind of like Megan talked about earlier. So again, a will is not going to cover all your bases. And what happens if there is no will? A lot of people, you'd be surprised at how many people don't have a will. I work in healthcare for 32 years. You'd be surprised how many people didn't have an advance directive or a durable power. Responsibilities will fall to a personal representative who will act upon the behalf of the deceased until a court will initiate or appoint somebody. So again, not having a will isn't going to solve all your problems as a business owners. What if the sole proprietor is disabled? This is a big one. Can the successor run the business? Disabled, you may be able to do, the thinking of the business, but again, if you are the manager, owner, and the key guy in there, can your successor do everything that you did, all the hands-on stuff? So I just want to give you guys, some questions, and so you can fit in how the buy-sell can help. So, and what if the sole proprietor retires? Here's a good one. What if the sole proprietor retires? I don't have an answer for that because again, that can be open-ended. If I'm a sole proprietor, what I said earlier, a lot of people stay working in their business way past retirement age because they don't have a plan to move forward. And not only did they not have a plan to move forward, so they continue to work, a lot of business owners, self-business owners, haven't started saving for their retirement yet. They're not ready to retire, even though they want to retire in 10 years. A lot of people started businesses because they don't want to have a boss. They don't want to, build somebody else's dream, but they don't start, they build their own dream, but they don't prepare for their dream's exit. Make sense? Again, can the successor run the business? Partnership. This is another popular one. What happens if the partnership dissolves? What if one partner elects to withdraw? Remember, it's not always about death or retirement or disability. One of them can elect to withdraw. Or there's another reason, one can be removed by a vote or a judge. The co-owners can vote somebody out, or they could have done something heinous. They could have done something illegal, and they could have been, incarcerated, or the co-owners could have taken them to court and have them removed. There's a lot of different ways where a partnership can dissolve. What if one of the partners declares bankruptcy? Do you want the whole business, the co-owners, to have to take part of that bankruptcy? Remember, if you're a sole proprietorship or a partnership, you're equally responsible for all the liens and the fines and the bills. If one of you file bankruptcy, that puts unnecessary burden on everybody else. Buy-sell agreement can help with that. Or again, there's an easy one. One passes away or one becomes disabled. So again, buy-sell is very great in all of these scenarios. What if a partner passes away? Without a will, there's no agreement. What if the heir of a deceased partner has different ideas about the business? Remember, this is growth versus current income. The partner may not just say, you know what, I don't want part of the business, or I'm sorry, the estate or the remaining spouse. They don't necessarily have to be rude or disrespectful, say, I don't want part of the business, just pay me out. You have to remember their spouse who was a co-owner, you're losing that current income. So they have a different agenda. They're about, hey, we got 2 kids in college, and I need to make sure I have enough money to pay for their college. I need to pay for the house. I need to pay for the cars. I got all the things that you used to pay for, and you're gone now. So I may not care about the growth of the business. I may not care that you want to put more money into the business. I need my finances taken care of. So again, the deceased partner, the heir of the deceased may have very different ideas about what they want to do with that business. What if the heir was not active in the business? Remember, the remaining partners have more burden. So getting you guys right out on time. I want to thank you for letting me speak to you. I hope you learned something. Again, if any questions, feel free to ask Megan. My name is Ray Rosales. I'm Rain LLC. That's my phone number. I'm out in California. That's my email address. But again, please point all your questions toward Megan or your center. And, but I just want to give you my information.
Real quick before we go, Ray, when they're working with somebody they've created their agreements and they're going to an insurance agent. Are there some tips? Like I know what I would tell them as they go into insurance companies or insurance agents. What are some tips that you would tell them to make sure? Because we know that these can be written badly. You and I know that these can go the wrong way. What are some things that the business owners can do to protect themselves against them going badly?
Well, yeah, like you said, Megan, we're in the industry, so we know there's really no bad agents or bad companies, but there's just a kind of a mix of both. What I would do is I would go with an agent that has reputable companies in their portfolio. And I'm very biased about this because I'm an independent broker. So I'm going to have a very biased opinion on this, or biased statement. I would go, me personally, I like to give a business owner options. I wouldn't want to say, I like to say that I'm Best Buy of financial services, because I'm not selling company A or company B. I sell all the companies, or a majority of companies. So I would sell what is best for that client's needs. So if I were to give you some advice, I would say go with an agent that is knowledgeable and has kind of a lot of weapons in his pocket.
So another thing, and this goes for any insurance, health insurance, life insurance, for your personal key insurance, buy-sell executive, go. And I usually will say to get 3 options. Ask them for, I need a minimum of 3 options. Correct. So that you can compare different options. You're not just saying, oh, this is the best option, go, and you're taking that insurance agent's word for it. Exactly. Go with 3, get multiple different options so you can sit down and look. And if you don't understand what you're reading and you don't understand what you're looking at, then sit down with somebody who does. Sit down with somebody that's licensed. For example, myself, I'm licensed. I wouldn't be the agent, obviously, on record, but I could read and say, this is what this means, and this is what this means, and be able to kind of explain. You need to know exactly what you're getting before you sign a policy, if that makes sense. Make sure there are no questions, or because if there's questions and somebody just tells you, oh, it's great for you, then you need to be concerned. At least that's the way I feel about it. Ray, you can say otherwise.
No, I 100% agree. You should never, and I'm going to be speaking for myself. If I came to you with one option, you should never take that option, because you should look at options. Again, Megan hit it right on the head. 3 is kind of, it's kind of should be the standard, industry standard. But again, I can't speak for anybody else, but 3 again is something, because if you have 3 options from 3 different companies, then you are 100%, you should be 100% educated how all 3 work and how those 3 can help your situation. You're muted, Megan.
I'm getting my assistant to answer the phone.
Oh, okay. I'm sorry.
Sorry.
No worries.
I normally answer my own phone just because, and then when I'm in meetings, I have to have him answer it real quick. So sorry about that. Anyway, but yeah, make sure you get options because if you just have one come to you and you don't have anything to compare, you get yourself into trouble for sure. And I think that's about it. I really appreciate Ray taking time out of his incredibly busy schedule to be able to come and join us. I know this is a different time than we normally have for Methods of Modern Finance, so I appreciate everybody being very flexible. Ray, thank you so much for taking time out of your schedule to join us and to give all this information to our business owners. And we appreciate it being so flexible and being able to allow our business owners to call you for more questions and giving you your information out as well. We really appreciate that. And if you are watching the replay on this, feel free to leave any questions or anything that you have in the chat. I monitor those every single day, and we appreciate you joining us. We will be back again next week at our normal time, 1 p.m. Mountain Standard Time, to do the next episode of Methods of Modern Finance. Thanks, everybody, for joining us.